perspective, because not only when you sell inventory, you not only record a sale price and either cash coming in or a promise to be paid, account receivable, you also need to show that you lost some of your inventory because it was given to the customer. And when you do that, when you show a reduction of your inventory, where we end up putting that is into an expense account called cost of goods sold. So that's the new step that we're going to, that's going to be a constant now from here on out through the rest of the semester. Every time we make a sale, we're going to show, one, the sale money coming in and the money being earned, but then step two, showing the inventory going out. Because just because we made $500 on a sale of, say, a lawnmower, we didn't really bring in net $500 because we had to pay money to buy that lawnmower in the first place. Thus, we may have only netted $100. And that's where this new account called cost of goods sold is going to come into play. And again, this is an expense account and going to be treated very similar to an expense, and it's going to go on the income statement like the expenses do. But it's, as you'll see in a little while, it has its own place because it is pretty important. It's one of the largest expenses that a company has if they sell inventory. Now, some companies, like a legal firm or, say, a mowing company, they're not going to have inventory. They don't have a cost of goods sold. They're completely a service business. So this is only for your inventory type companies. So here's my little example just to help get us started here. If we sold 100 units for $3 each for cash, and I'm also told that those items that I sold for $3 each, I had originally purchased those myself for $2 each. So thus I have a nice little markup. The journal entry would be, what did I get? That's my debit question. So I got money, cash. And how did I get it? Well, I did my job, and we call that revenue, or in this case, sales revenue. So there's my first entry that we're familiar with throughout this class so far. It's the second entry that's the new one. This is my COGS, or is my expense account, cost of goods sold, and that's showing now when I combine this with my sales revenue later on in the income statement, it's going to show that I've really only earned $100. It would be misleading to say that I had netted $300 here. When yeah, I did earn $300, but the first $200 I had to spend just to get the item. Thus, I credited my inventory, therefore reducing my inventory T account and showing the balance going down for that piece that's gone. Okay, there are two different ways, two different times to record cost of goods sold. If you're a real small store, you could easily do it and be fine on the periodic method. Periodic method is kind of what it sounds like. You don't do it anytime at any one point. You just do it periodically. Instead of doing it after every single sale, updating your inventory and your cost of goods sold, you may only update at the end of every day, or possibly if you don't do a lot of business at the end of every week. You're going to go through, count up in a little ledger that you have off to the side saying, I bought this much stuff within the last time that I have calculated, so within the last day, within the last week. Note what I started with in inventory, how much I purchased throughout that time span, and then go in and count how much is left. So if I had 5 tractors and I bought 2 more, I had 7 total available to sell, and then when I go back and count, I only have 3 left. That's telling me that I sold 4 items. And that's kind of what this little equation here, that it hopefully will help you to kind of see this in a visual layout. I had say the 2 tractors to start with. I bought 5 more, so I had 7 there ready to sell. Maybe not all at one time, but I had 7. I only had 3 left in my ending inventory when I actually went and counted. Therefore, I have 4 sold, cost of goods sold. Then you have to go to the point is, well, I have 4 left. How much did those cost me? And that's what we're going to look at when we get down here to determine the cost. The second way, instead of counting at the end of every day or every week your ending inventory, you could simply go through and update your cost of goods sold after every single sell. Now, if you have a computer system with scanners, that's not hard to do at all. The computer does all the work for you. It's a little bit tougher to do, especially if you have a whole bunch of items that are exactly the same and you sell mass-produced items. For example, if I sell gasoline and I bought, as my company, I bought 100 gallons at $2 a gallon, and then the next day I bought another 100 gallons and the price jumped to $2.20 a gallon. And then during that time I sold 150 of the gallons. Well, which gas did I really get rid of? Did I get rid of the $2 gas, or did I get rid of the $2.20 gas? So when I'm counting up my cost of goods sold or my ending inventory, that's going to be a question that comes up. Which gas did I really sell? Did I sell the early stuff or did I sell the later stuff? It was all intertwined. So it's impossible to know. So that's why in accounting we have a specific method set up that says when it's impossible to know what you actually sold, do it like this. The perpetual method, again, is going to update after every single sell based on which method, as we're going to find out below, you decide to use. The specific ID is probably the easiest, but probably the least common as well, in that most times when you buy stuff at a store, they are mass-produced items, like a gallon of milk. All of the milks look exactly the same. So when you sell one milk, you don't know which gallon did that come from. Did that come from yesterday's shipment or today's shipment that cost a little bit more or a little bit less? However, when it's things like an automobile that has a unique VIN number, or a piece of jewelry, and the jewelry are all unique, possibly at some store, then you can easily do the specific ID and say, I sold this 22 karat gold necklace with this many, however they decide to classify it, and I know I bought that piece for $350 and I sold it for $800. So I know exactly what my cost of goods sold is. So again, that could be the easiest, but it could be the least common too. Just depend on the type of business you have. For all these other items that are mass-produced, the company's got to pick, and they do pick, and any one of them is allowed. They're fine to do. You just pick with it, and you generally will stay with it. Because if you change, you are allowed to change, but it becomes very messy, and you have to go back and report prior years, so it gets to be expensive because there's a lot of time involved. One of the first methods to do is called the FIFO method. First in, first out. So the items that you had purchased at the very beginning, or what's still in your beginning inventory, are deemed to be sold first. We don't know if it was sold first, that particular unit. But for cost purposes, we're going to pretend that it was that unit that was sold first. So in my milk example, whatever I had from the day before, which would make sense to use this for milk, those are the items that I'm going to sell first, cost-wise. Whether it is or not, doesn't matter. Cost-wise, that's what I'm going to use. So advantages, good and bad, to the FIFO method. The good part is with FIFO, your ending inventory is very close to what actual market is, because your ending inventory has the items you just purchased. And if you just purchased them, that's a pretty good indication of what the market is selling them for. Your ending inventory that you have on your books is going to be very close. However, the downside then is what you're selling is some older costs. You're selling the older costs that you had bought a few days ago, a few weeks ago, whatever it would be. So therefore, your cost of goods sold may not be as accurate in using this instance. And then we have the LIFO method, which is just the opposite, last in, first out. So the items we just purchased, maybe in the technology division, this really works well. Items you just purchased, like say an Xbox One, when those first day they come on sale, those are going to be generally the ones that are sold. The Xbox 360s that are a little older version, yeah, those are still going to sell, but not quite as fast as the Xbox Ones. So last in, first out may be a little more accurate method for that type of business. They're saying that the last cost that came in, maybe those more expensive ones with the Xbox One, because they cost more to purchase by the retailer, are going to be the first cost, are going to be the cost that we show as going out, which would make sense because we mainly sold those most recent products. So therefore, if I do this, it's just the opposite of FIFO for the advantages and disadvantages. Here, our cost of goods sold is going to be a lot closer to actual market, whereas the ending inventory is going to hold the older stuff and maybe not be quite as accurate. However, if there's a period of rising prices, they continually go up. That would mean, so your prices continually go up. With LIFO, you're selling these high-end items. Therefore, your net income is going to be a lot lower if you're selling more expensive items on your books. So instead of, say, 300 minus 200, it's now 300 minus 240 because you're selling more expensive. You have a lower net income, and if you have a lower net income, you have a lower tax if you're a corporate. The average cost method is kind of a good mix between both of them, and probably is the one I would prefer the best if I was in a company, I think. What we're going to do is add the total cost of our inventory. Instead of looking at it from individual dates, we're just going to add up everything we have, all costs together, and then divide it evenly by every single product that I have. So if I have $200 in product and I have 20 items, I just simply divide that out evenly, $10 a piece. So each item that I sell is I bought for 10 bucks instead of, sorry about that. Make sure I got this on vibrate. So each item that I sold is now going to be a $10 cost of goods sold instead of maybe 9 or 12, depending on the date that I bought it. I just averaged it all out. Okay, so let's look at how the income statement is updated now that we have this cost of goods sold. And we've also thrown in these last week's items, the sales discount and sales returns. So we've got my sales revenue over here, less the items that were returned or discounts that I given. We then call that my net sales. What did I really sell at the end of the day? Because you don't want to count these returns. And then this is our new item, our cost of goods sold. We're going to subtract out our sales less the product that we got rid of that I had to buy. And that's going to give us a very important number in accounting that you're going to see quite a bit from here on out. It's called gross profit. How much money did I make before any other expenses are involved, like wages, rent, electricity? That's what we do down here at the end. We take out most of our expenses. We get our operating expense. And then figure out how much income we have. At that point is when we go ahead and figure up our income tax, because you always figure your income tax on your net income. And you wouldn't want to figure your income tax on your gross profit. That would be a much higher income tax, and nobody wants to do that. So your gross income minus, or your operating income minus your tax if you're a corporation. If you're not a corporation, if you're a sole proprietor or a partnership, you don't have that. You don't have these final two lines. You just have simply net income. But this book focuses more on a corporate type structure. The last thing to mention here that you're going to see in your homework is how to estimate what your cost of goods sold is by knowing what your gross margin is. So you have done your business for a little while. You know that your gross margin is a percentage. And gross margin says if I had $40 in gross profit and $100 in sales, I have a gross margin of 40%. For every dollar I earn, 40% of that is going to be profit. So you always just take your profit and divide it out of your sales to get your gross margin. If you know your gross margin, you can easily then estimate what your cost of goods sold will be. And let me just quickly go through this. This is the beginning of the old formula that we looked at, where we had beginning inventory plus purchases. Tells me how much stuff I have available for sale. That part didn't change. The only part that did change is saying what's my sales revenue less my estimated gross profit. So if I know this number and I know this number, I can easily figure out what this middle number is. And that's what it's doing here. It's just looking at the equation a little bit differently, looking at the income statement to determine what our estimate cost of goods sold is. If I know an estimate of what my gross profit is because of that gross margin given, then I can easily get the cost of goods sold. And then you can, if you know your cost of goods sold, you can work backwards even further and determine what your inventory is, how much inventory you have left. Let's look at an example, a couple examples that I have of FIFO and LIFO and average cost. And I'll have these available for you in the Blackboard in your resources folder that I have each week set up. Here's my practice example. I have some different dates happening here, what we started with for the beginning of the month, and then some purchases that I made. And then at the end of the month, what I had left. Notice I don't have a cost here because, well, that's going to differ depending on what method I use. I then tell you that each item sold for 40 bucks a piece. And 75% of all of our sales were made via cash. I'll be right back, and we'll finish this problem out. And I want to. Okay, back here to finish up our example. What I wanted to show you was these answers and what I did to solve each of these problems when I asked for what's the total sales, what's our cost of goods sold, what's our gross profit. So what I did with this FIFO example is, well, we got to use what we're given, and then FIFO meaning first in, first out. If we're told we only have 150 left, I need to determine what those 150 are valued at. So I look back up and with what I had. If I have 150, the first in, first out are gone. So my first two items are gone, leaving me with the final purchase, and I have 150 of these items left. And when I did the calculation, when I take 17,000 over 500 units, I'm down to $34 per unit. So that leaves me an ending inventory of 150 at 34 bucks a piece, or $5,100. The second thing that I do is I look up and I see how much items did I have available for sale. So it was 29,300. I take the 29,300 total items that I had minus what I still have left, because I haven't sold them obviously, and that's going to tell me my cost of goods sold. And that's what I did down here in my little formula. I took what I had available minus what I still have, and I got the cost of goods sold. It told me here that I sold 900, let's see, how many did I sell? We had total units, we had 900, so I can determine again how many I sold. I had 900 units when you add up all three, and then you subtract out the 150 that I still have, so I sold 150 units. And then at 750 units at 40 bucks a piece, I'm bringing in $30,000 in total sales. And then I simply do the math to determine how much of it came in via cash, how much was on account, the percentages I mentioned at the very beginning. So there's my total revenue. Subtract out my cost of goods sold. So my two really important numbers here for my income statement show that I had a gross income of these two subtracted from each other, which is $5,800 in gross income. Now we look at it from the LIFO perspective, and I do everything just the opposite. The ones that I sold, if I have 150 left, I got rid of all of my beginning or my most recent purchases. I still have the 100 here and the 50 from my most recent purchase, and I did the calculation, and those are 31 bucks a piece, so I have 50 items at $31 a piece. So in my ending inventory, I have the 100 units costing $3,000, all of these, and then 50 of these guys at 31 bucks a piece. So that's $15.50 for a total ending inventory of $45.50. Then I just do the same math that I did before. Take my beginning $29.3, subtract out the $45.50 ending inventory that I just found, and there's my cost of goods sold. Notice the sales aren't going to change. So my inventory and my sales here, that's all the same. Nothing changed here. The only thing that changed was my number for cost of goods sold. Now let's look at the last one, the average cost. Average cost is maybe, I think it's one of the easier ones. What I'm going to do is determine, instead of having all these different dates, all I'm going to show is I have $29,300 in product cost divided out over 900 units. So that gives me an average cost of $32.56 per unit. So if I have 150 left, I can easily determine what my ending inventory is in dollars, and then pop that right into the equation and get what my cost of goods sold is. Again, the only thing that's going to change in my journal is my cost of goods sold journal entry. All right, let's look to let's go to our homework.